Dude, I think I figured it out. I can finally afford a house.
Did you win the lottery or something?
No, instead of a 30-year mortgage, I can get a 50-year mortgage. Payments are way lower.
A 50-year mortgage, you're going to be paying that off in your 70s.
But I can afford a house.
Let's break it down. Is a 50-year mortgage something that's actually viable, or is it financial suicide in slow motion?
Stop wasting money on that dumb shit and instead put it in investment. I know it's tempting. You'll spend it and be broke again.
So welcome back to another video, guys. I'm your bro, Ryan.
And I'm your bro, Taylor.
So in this video, as you can tell, we are talking about the 50-year mortgage. What is it? How does it work? Is it the right move? And when could it be the right move? So what is a 50-year mortgage? It's just what it sounds like. It's just like a 30-year mortgage, but it's for 50 years instead. And so it works pretty much the exact same. However, not a lot of people do know how mortgages work, so we're going to go a little bit more into that in just a second. But basically, a 50-year mortgage has been thrown around a couple of times. It's not super common in the US yet. Some lenders offer it, but it's kind of a special product. Other countries, especially in Europe, do offer a 50, and I think Japan offers up to like a 100-year mortgage. Something crazy.
Yeah.
But a lot of these are also considered, or a lot of these countries allow what's called generational transfer. So you can have that mortgage and then pass it down to your children, which is kind of a crazy concept, but it could be beneficial in the end. I don't know all the terms on that. But again, this is just an idea they're throwing around in the United States right now to make homes more affordable. So does the math, and how exactly do mortgages work? Let's jump a little bit more into that. So how mortgages work, basically monthly payments stay the same throughout the mortgage, but the split changes drastically over time. In the early years, almost all of your payment goes to interest and barely any of it goes to the actual principal of the loan. So what does that mean exactly? Let's put it into an example. So if you have a $320,000 mortgage at 7% interest, your very first payment would be $2,129, and that breaks down to $1,867 of interest and only $262 towards principal. That big payment and only $262 actually goes towards the loan. That's crazy to me. Not a lot of people know that, and as you pay down the loan, or as time goes on, it slowly starts to flip. And basically, once you hit the 15-year mark, so you're paying on this place for 15 years, that's the first time, that next payment is the very first time that your principal portion of it is greater than your interest. Now with a 50-year, you can think it's going to act very similar, right around that halfway mark, so about 25 to 30 years in. So the length of that entire other mortgage, now for a 50-year mortgage, 30 years in is when your principal is greater than your interest. Oh my gosh, I can't even imagine. Yeah. I'm not even 30. I haven't even been alive 30 years, and I would have to wait that long to the point where I'm paying greater towards the house than I am paying the bank. Yeah. Just unbelievable.
So as you might be able to guess, the interest payments or the total interest paid towards these two loans is very different. I mean, 30 years of mainly interest payments, goodness gracious. Yeah. The overall money the bank is making off you is insane. So let's actually dive into the real math and the real numbers behind this. So we're going to use the same house for both of these mortgage terms. So let's say it's a $400,000 house and you're able to put 20% down in both instances. So the mortgage itself is only $320,000, and let's say it's at a 7% interest rate. So, like we said earlier, that 30-year mortgage, your monthly payment is going to be $2,129. The total interest paid over the life of that loan is $446,428. Which of course brings your grand total up to $766,428. That's a lot of money towards interest only. Now buckle up for this. The 50-year mortgage, let's say it stays at that same 7% interest rate. Your monthly payment drops down a little bit to $1,925, but over the life of the loan, you're paying $835,242 in interest alone. Your grand total exceeds $1 million at $1,155,242. That is insane. And in reality, a lot of times when you go for a longer term, your interest rate trickles up a little bit. So let's say that 50-year mortgage is at a more realistic 7.72%. Your monthly payment sits at $2,104, which is only a difference of $25 a month. And your total interest paid jumps up to $942,121. bringing your grand total past $1.25 million. So let's say that you even went with that middle scenario of it staying at 7% for your 50-year term. You're only saving a couple $100s a month, but over the life of the loan, you're paying almost $400,000 more in interest. That's just a little bit hard for me to stomach. I don't like doing the math on my 30-year mortgage and figuring out like, wow, I'm paying more interest than principal. This is a scam. So trying to stomach that, even if you do kind of staggered across generations in this case, it's a tough pill to swallow.
So in this scenario, the math looks pretty terrible. But there've got to be scenarios where it makes sense to get a 50-year mortgage, right? So first, if it's really, really expensive market, okay, maybe that's the scenario to get in. It doesn't save you too much or help you qualify too much for only $200.
Yeah.
And maybe, like I already kind of mentioned, maybe your plan is to get in with a 50-year term because it's all you can qualify for in this moment, but you know this year you're going to get a raise. Maybe you're expecting a big bonus, and that'll help you qualify for a 30-year in a very short period of time, and you refinance. And then you get a better term, you get a better interest rate potentially too, and then you're in a good situation. So maybe it's just the entry into it.
Okay, so we see a few scenarios where maybe it'll work, but let's go over a few reasons why it's probably terrible.
All right, Debbie Downer.
The reality is your equity is building painfully slow. All those payments towards interest, that's not building you equity in the house. You're simply paying the bank what they want. So it's a slow trick. I mean, a 30-year mortgage is oftentimes slow enough. A 50-year, like we said, most of your payments for the first 30 years are going towards interest. So in the end, if you're like moving in a couple years and you're looking to sell your house, you've built up no equity. You're not going to really turn a profit unless the market somehow exploded in that time. So it's just tough from an ownership perspective.
And honestly, to your point, like life happens and sometimes you got to move. I think the average before COVID and everybody stayed in their homes was like 7 to 10 years and people were moving. Yeah. So it's like at that point, you haven't built up any equity. You're basically going to pay all the fees to buy it, all the fees to sell it, and those fees to sell it are going to outweigh any equity you had. So you're really going to owe the bank more and more and more. That it doesn't sound like a good idea.
Yeah. To the points we made earlier, this kind of needs to be a generational home for it to even make sense. Because, I mean, look at it. The sense of, like, retiring with a mortgage that still might have, like, say, 20, 30 years left on it, I can't even comprehend. There's, like, no stress relief that comes along with that. Yeah. You know, hopefully by the time you're nearing retirement, you're kind of like, okay, I've either paid off my 30-year mortgage or I'm getting very close. 50 years? I mean, I would have needed to start yesterday, that kind of thing. Actually, a few years ago.
You got to sign the house at 15 to retire with a paid-off mortgage.
Yeah.
That's crazy. Yeah, 15.
The concept alone is just making my head hurt. And kind of building on that, just look at the opportunity cost. I mean, that extra nearly $350,000 you're paying in interest, if you were to say put that in the market and get an average 8% return, you're looking at a couple $1 million. So when you think about it that way, you're like, okay, I'm kind of sacrificing a lot of my retirement for a nicer house in the now. I mean, of course, this is a case-by-case basis. We're not saying, hey, completely dismiss it, but, you know, we're just giving our honest opinions on what we would do for us, and for me, it's just hard to stomach.
Yeah. You're getting a short-term, small amount of affordability for a long-term lock-in and a long-term expense.
Yeah.
That it doesn't make a lot of sense to us, to be frank. So what are some alternatives to the 50-year, but can still help with affordability? So for option one is, I know it's going to sound super simple, but go smaller, go simpler. Or maybe instead of a 4-bedroom, 3-bath, you go 3-bedroom, 3-bath, or 3-bedroom, 2-bath. At least for the time being. You don't have to be there forever, but at least for the time being, because instead of that $400,000, maybe you can get a $350,000 house at 7% on a 30-year.
Yeah, and another option might be something like house hacking. I know that might be a bit of a case-by-case basis. Not everyone's open to that kind of thing, but if you were to invest in something, say, like a duplex, you can attribute some of the rent money that you're expecting to make to your monthly payment that you'll have to make, so you can qualify for, quote-unquote, more of a home. Now, I know that some people are like, I don't want to have a roommate. I don't want to share this. I don't want this responsibility. So, again, case by case, but we're just presenting you with some alternatives.
And lastly, I know this is easier said than done because usually this is the harder part of getting into a house, but coming in with a larger down payment. If you took a little bit of extra time to save and maybe rented a little bit longer, saved up a little bit more, and put that down on the house, obviously your loan would be less, so you could afford that house at maybe a 30-year mortgage. So that's, again, I know the down payment's typically the hardest part, but that can help. If you're just between a 50-year and waiting a little bit longer, it's probably better, based on the numbers, to just wait a little bit longer.
Because, yeah, I mean, you think about it, you're going to have to wait another 20 years on a 50-year mortgage just to own the home outright. So, 50-year mortgage, yes or no?
Well, based on what we just went through and the math we showed, it's going to be a hard pass for me.
Okay, good. I'm glad you came to your senses. There are just so many better alternatives out there.
I agree. So if you guys found this video helpful, please let us know in the comments. Please give us your questions, your best insight in the comments. As always, don't forget to subscribe to our channel. And as always, don't forget to stay tuned for the next one.
Stop wasting money on that dumb shit and instead put it in investment. I know it's tempting. You'll spend it and be broke again.